Let me be brutally honest with you right out of the gate. Wall Street has spent billions of dollars running marketing campaigns designed to make you believe one massive lie, that you need to be rich to start investing. They want you to think that wealth building is a secret country club reserved exclusively for people with six-figure salaries, trust funds, and Ivy League finance degrees. They use complex, intimidating jargon like derivatives, yield curves, and alpha generation. Why? To scare you. To intimidate you into keeping your hard-earned money in a traditional savings account, where it slowly rots away, month after month, due to inflation. But here is the absolute truth that the financial elite do not want you to know. Generational wealth is not created by picking the next hot crypto coin, and it is certainly not created by day trading penny stocks on your lunch break. True wealth is a highly predictable, boring, and calculated mathematical equation. If you can find a way to scrape together just $3.30 a day, literally less than the cost of a watered-down iced coffee at Starbucks, you have enough capital to leverage the single greatest wealth-building machine in human history, the S&P 500. Welcome to the Dollar Intel Masterclass. In this comprehensive blueprint, we are going to strip away the complex garbage. We're going to break down the exact math, the psychology, and the step-by-step technical process of turning a completely unnoticeable $100 a month into a seven-figure portfolio. Grab a notebook. It is time to stop playing defense with your money and start playing offense. Before you put a single dollar into the market, you need to understand exactly what you are buying. Most beginners think they need to go out and pick winning stocks. They try to guess if Apple will sell more iPhones this year, or if Tesla will deliver more cars next quarter. Listen to me, that is not investing, that is gambling, and statistically you will lose. Instead of looking for the needle in a haystack, the S&P 500 allows you to simply buy the entire haystack. The Standard & Poor's 500 is essentially a VIP basket containing the 500 largest, most profitable, and most dominant publicly traded companies in the United States. When you invest your $100 into an S&P 500 index fund, your money is instantly split up and distributed across all 500 of these massive corporations. You instantly become a partial owner of Apple and Microsoft for tech dominance, Amazon for e-commerce, Johnson & Johnson for healthcare, Visa and MasterCard for global finance. You are literally hiring the smartest CEOs in America and millions of their hardworking employees to wake up every single day and generate profits for you. If you think this sounds too simple to be profitable, let me tell you about the most famous bet in Wall Street history. In 2007, the greatest investor of all time, Warren Buffett, issued a challenge. He bet $1 million that a simple, boring, unmanaged S&P 500 index fund would completely crush the returns of highly paid, elite hedge fund managers over a 10-year period. A firm called Protégé Partners took the bet. They handpicked 5 elite funds managed by Wall Street's sharpest minds, charging massive fees to their wealthy clients. The result? An absolute bloodbath. Over the 10 years, the expensive hedge funds averaged a pathetic 2.2% annual return. Warren Buffett's simple index fund? It delivered an explosive 7.1% compounded annual return, completely annihilating the so-called experts. The lesson is clear. Stop trying to outsmart the market. Just buy the market. Now, let's get to the rocket fuel. Let's talk about compound interest. Albert Einstein reportedly called compound interest the 8th wonder of the world, stating, "He who understands it earns it. He who doesn't pays it." When you invest $100 into the S&P 500, it historically grows at an average rate of about 10% per year. At the end of year 1, your money makes a little bit of profit. But in year 2, you don't just earn interest on your original $100. You earn interest on your interest. Over decades, this creates an unstoppable snowball effect that defies human logic. Let's look at the brutal math of investing just $3.30 a day. By year 10, you'll put in $12,000 out of pocket, but your portfolio is worth over $20,000. The snowball has started. By year 20, you'll put in $24,000, but it has grown to nearly $76,000. By year 30, your $36,000 investment is now worth over $226,000. And by year 45, You have contributed exactly $54,000 of your own money, but your portfolio value? $1,058,108. You are a millionaire. The S&P 500 and the math of compound interest completely generate. If you are reading this and looking at the current stock market, you might have hit a massive mental roadblock. You see that a single share of an S&P 500 fund costs somewhere around $500. The immediate thought for 99% of beginners is, wait a minute, you just told me to invest $100 a month. How am I supposed to buy it if one share costs 5 times that amount? This exact misconception is what keeps millions of Americans paralyzed and broke. They think they need to save up $500 in a coffee before they're allowed to buy their first share. Enter the greatest Wall Street cheat code of the 21st century, the fractional share loophole. Thanks to fierce competition among modern U.S. brokerages, the days of needing to buy whole shares are completely dead. Today, you can buy a slice of the pie. If a share costs $500 and you deposit your $100, the brokerage's algorithm simply slices that share and gives you exactly 0.20 shares. Your money starts working for you on day one, down to the exact penny. This loophole completely destroys the excuse of, I don't have enough money to start. Information without execution is just entertainment. Reading about compound interest will not make you rich. Putting your money into machine will. Here's the exact step-by-step process to set up your wealth-building machine today. Step 1. Open a zero-fee brokerage account. A warning right now. Do not walk into your local brick-and-mortar bank to start investing. They will aggressively try to sell you their actively managed mutual funds, loaded with predatory fees that will eat half your profits over 30 years. You need a zero-commission online brokerage account. Pick Fidelity Investments or Vanguard. Go to their website, click Open Account, select Individual Brokerage Account, and fill out your information. It takes 5 minutes. Step 2. Pick the right ticker symbol. You do not log in and type S&P 500. You have to buy an ETF that tracks it. The only difference between them is the sneaky annual fee they charge you. Do not buy SPY. The fees are a trap. You want to buy VO from Vanguard or FXAIX from Fidelity. These are the undisputed gold standards with practically zero fees. Step 3. Total automation. This is the step that guarantees you become a millionaire. Human beings are emotional, undisciplined creatures. If you rely on your own willpower to manually log in and transfer money every month, you will fail. You must automate the discipline. Log into your new account, link your primary checking account, and set up a recurring transfer rule. Tell the system to automatically pull $100 on the first of every single month and automatically buy your chosen fund. This is called paying yourself first. Set it, forget it, and let the algorithm do the heavy lifting for the next 3 decades. Setting up your automated transfer is the foundation. But if you want to put your wealth-building machine into overdrive, you need to understand the drip secret. When you own shares of the S&P 500, you are a part owner of 500 highly profitable companies. Every 3 months, these companies take a portion of their massive profits and distribute it directly to you as a cash payment called a dividend. Here's what amateurs do. They let that cash sit there, or they withdraw it to buy coffee. Never do this. The wealthy turn on DRIP, which stands for Dividend Reinvestment Plan. It is a free setting inside your brokerage. When you turn DRIP on, you are telling the algorithm, do not give me that cash. Immediately take it and buy me a tiny fractional sliver of more shares. Those new shares will generate their own dividends, which by even more shares, it creates a localized financial tornado inside your account. Turn DRIP on and do not touch a single penny of your dividends for the next 20 years. Finally, we need to have a serious conversation about reality. At some point in your investing journey, you're going to wake up, log into your account, and see a terrifying sea of red. Your portfolio might be down 20 or 30%. The news networks will be screaming about a recession and the total collapse of the U.S. economy. This exact moment is what separates the millionaires from the middle class. The average American panics and sells at the absolute bottom, locking in their massive losses. Wall Street does not panic during a crash. They celebrate. If you went to a Rolex store and saw a $10,000 watch was suddenly on sale for $6,000, you wouldn't run away. You would buy it immediately. The stock market is the only marketplace on earth where consumers run away in terror when the best assets go on a massive discount. The Dollar Intel rule from market crashes: do absolutely nothing. Do not sell a single share. Let your automated machine keep buying at those cheaper, discounted prices. Historically, the U.S. stock market has recovered from every single crash in history and gone on to hit new all-time highs. You now possess the exact blueprint that wealthy families use to build generational wealth. Open your account, set up your auto invest, and turn on drip. If you want to free up even more cash to push into your new portfolio, you need to stop paying predatory interest rates to the banks. Click the video on the screen right now to watch my ultimate 30-day blueprint to hack your FICO score to 750 plus. Take control of your money. Beat the system. I will see you in the next one.